Hello, it is a wonderful morning, and this is going to be lesson one of the day trading module. And today we're going to discuss essentials to day trading. And the specific topic, so it's going to be multiple parts. I think it's going to be probably up to 5 parts. So we're going to go over some really basic concepts to which we did not touch on module 1 and 2 and 3. Alright, so today we're going to talk about the market maker buy model, and then the next video is going to be on the market maker sell model. Now, the market maker buy model just stemmed from the standard commercial accumulation phase, which we talked about on module 2 when we're talking about the COT report. Now, if you remember, if you've gone through that content, we talked about how when price declines, the commercials will buy in by hedging into price. So they create their hedging program by buying in as the market declines, and every single time the market runs lower, they buy even more, and every single time the market runs lower, they buy even more. And essentially what they're doing is they're building in a net long basis, so that when the market runs to a key higher time frame level, they are extremely net long, and the sellers already absorbed in price. And then there is a shift in order flow, and as the market starts to rally higher, they start to offset distribute their previously long positions or bought positions to the funds who want to buy the new trend. And so what you have is a standard commercial accumulation phase, whereby as the market runs lower, they engineer order flow by buying into each decline, and then as the market starts to run higher, they continue to engineer order flow by offsetting their old bought positions through mitigation. So as the market runs higher, they mitigate old positions, and the process of mitigating old positions allows them to facilitate order flow through the funds or large speculators who are coming into price, and they are looking to chase higher prices. And this is your classic standard accumulation phase. Now, what's really important with this cycle here is that when they are extreme net long, that oftentimes will be at a higher time frame discount. It could be like a weekly bullshit block or a monthly discount array. We don't know what that discount array is, but we know at an high time frame discount array, there's going to be extreme delivering price, and we will a lot of times tend to see price reversals and a new order flow ensue, and that usually is how you get the standard commercial accumulation phase or cycle. Now we can take this concept, and this is where the concept of the market maker model stems from. And again, on this lesson we're talking about the market maker buy model, and it is just a mirror of the standard commercial accumulation phase or cycle. Now this is a diagram of the complete market maker buy model, and you can see it kind of is similar to the standard commercial accumulation phase. You can see the initial consolidation, and then the run down to support, where you have a small little range, and then price has a smart money reversal. Usually that would be at an high time frame level, and then you have your low risk buy, and then you have your reaccumulation, and then you run up into the previous consolidation. Now, sometimes this cycle or the phase of the run lower into support could be in 2 phases. It could be a consolidation, and this could have sometimes 2 phases, where there's one phase distribution, second phase distribution, and then smart money reversal, and then just low risk buy, and then just a reaccumulation, and then finally a run for the initial consolidation. Now, with the market maker buy model, we understand that price action is fractal. So the concept, this model being taught, is applicable to all time frames, from the 1 minute time frame to the 15-second time frame to the 10-second time frame, all the way out to a monthly time frame, because price action is fractal. But now what we're specifically focusing on is the lower time frame. So we are more interested in the 1 hour time frame and the 15-minute time frame or 5-minute time frame for day trades. What you want to do with this model is you want to employ the model, and I've talked about how price will deliver in trending market conditions. So if you go back to the short-term trading module, we talked about utilizing the quarter theory for trending market conditions. Right. So in a strong order flow, the market will deliver either in utilizing quarter theory or with the market maker model. Now, what I tend to look for first is the market maker model, because that is more evident of price delivery. Again, remember, price will deliver bullishly through the standard commercial accumulation phase. Right. So if I can look to the left and see where there was old buying from the commercials, I already know in the future where I'm going to look for potential setup. And that's a beautiful thing with the market maker model. It kind of like is a forecasting of price. It forecasts levels where you will identify buying opportunities in the marketplace. Because what usually will happen is, to see another leg higher, the market will create a small little consolidation at the previous distribution cycle or distribution phase. Alright, so as the market consolidates a little bit, commercials buy into that, and then it runs lower, commercials buy into that, and then it runs lower, commercials buy into that. And if you look at our journey here, you can see this small little consolidation, the commercials are accumulating longs, and then as the market runs lower, they're accumulating more longs, and then as the market runs lower, they're extreme net long, and then the market displaces, right, due to commercials being on an extreme net long basis, short term, because it's a lower time frame. And then we have displacement, and this displacement, which we've talked about, is what's necessary to validate institution sponsorship. And then go in here looking for higher prices. And what tends to happen usually is that retail will still think that this is a classic optimal trade entry sell. Right, so retail who don't understand nothing about price lever mechanism or price lever cycle, they're going in here and they're looking for sells because they believe that this is a return back up into a premium, and they're looking for a continuation lower. And a lot of times there'll be flashing signs of like trend lines and some kind of retail or market maker trap. It could be false head and shoulders, or it could be hidden divergence with an indicator, and they'll usually be flashing signs of a retail run lower, and then the market will just aggressively run for the initial consolidation, or not this initial consolidation, but we'll run for this consolidation, and then it'll reaccumulate inside this old price range, then expand for the original consolidation where existing retail sell stops will be resting at. Who's retail sell stops? All the retail who are shorting the rally, you're gonna have your stops being protected up here, and all the retail who are short here, they will jam their stops above this high. So the market will then pair up against them as counterparty liquidity, especially in the daily bullish order flow. So how do you want to employ the market maker buy model? You want to use this for a daily order flow that's poised or predisposed to be bullish. Right, it does not make sense to go in and utilize the market maker model for bearish order flow. You want to utilize this for a bullish order flow. And what you can see here is this is a live example of what the bullish market maker model looks like. You can see here, this is a chart of US dollar Swiss franc from 12th of last month. Now what you can see here is this is the daily divider. So this is 10 p.m. GMT or 5 p.m. Eastern Standard Time. Okay, so what you have here is you have your initial consolidation, which forms outside our kill zone, which is during near close, and then the market goes into that tight range, heading into close of day, into changeover session for a new day. And this is your first day distribution. And remember, I talked about how sometimes this could have two phases of distribution, right? Not just one. Now, you can have one phase distribution, and you can also have two phases of distribution. So this is the first day distribution where the market consolidates, and here, as the market goes up into this, commercials start to hedge into longs, the buy here, then the market declines and goes into smaller consolidation, and the commercials of buying as fund level liquidity shorts into the decline. Then we have a small little consolidation here. Again, you can see the proximity to sell side liquidity, and fund level liquidity shorts into the run lower as smart money buys, and as fund level liquidity keeps shorting, smart money are extreme net long here. Now remember, this usually will form around a key higher time frame level. You can see the time frame here. This is a 15-minute time frame, right? So we've run below a short-term low where sell side will be resting at, and by running below that low, we are inducing even more retail. So when I say retail, I don't just mean M2 traders. All right, there are more participants in the marketplace than what you think. The market runs and breaks a short-term low, and this, look at how fast it does this. So when retail looks at this, the speed of this delivery, they're induced to go short, and that induction of shorts induces a buy sell liquidity here, because the short sellers here, you're gonna want to protect their sells with protected buy stops, including all the shorters inside this run lower, right? And then you can see as the market trades down, and you can see that high time frame level here is a daily bullish order block mean threshold, and once we run lower there, this is happening at London session. So this starts London open, this 6 a.m. that's start of London open, where we have the initial consolidation. I'm going to talk more about the timing of each session. You have run lower, which is jitter swing, or the false move lower, and that usually will happen during the first 2 hours of London session. And you can see how retail will be induced to want to go short below the short-term low here. Then the market displaces higher and returns back down into a fair value gap with the bullish order block, and that's your low risk buy. Going back into this model, that's low risk buy. And what usually happens there is that retail will look at this as a retest back into an old range, and they're wanting to look for a continuation lower, and this is where they get sucked in and they get trapped. Now if you pulled your trend line from this side here and you're running through across, okay, so let's actually go back into this time window, which is USDCHF. So we're going to look for the actual time window so we can try and pull up the trend line and see what we're talking about. So that was the 12th of last month. I believe that was the 12th of last month. Now, this is what we're looking at, which is low risk buy, and if you pulled up your trend line, you're gonna see that we have a trend line sell. All right, that's a trend line sell, a classic trend line sell, because we have a break of support, which is what retail will interpret this as, of a break in support, right? So that's a break in support, and the market breaks slower, and the market returns in a premium with the trend line confirmation. And you can tell the market runs higher because retail has no understanding of price lever mechanism or price lever cycle, so they use the trend lines and just looking for lower prices, right? And this is what usually would happen at the low risk buy phase, where the market will usually flash some kind of indication that it wants to go lower to retail, and then retail chases that, and then you can see the aggressive run higher. Then the market runs higher and then goes back into the second phase distribution and accumulates there, reaccumulates there, and then you see expansion for the initial consolidation. And this is a complete market making buy model. Now if you zoomed out to a daily time frame, you're gonna see that daily order flow was bullish, and this is what you want to use for bullish order flow. You're looking for this kind of price delivery, right? Because what the market would do is, in retracement in a bullish order flow, you're looking to identify the left phase of the model. Alright, so you have two phases to the model. Here's the left phase of the model, and then there's the right phase of the model. Just like you have with your if that data ranges, where you have your look back cycle, then you have your cast forward. Alright, but with this one, you want to identify the nature of price delivery into your key higher time frame level where you're anticipating reversal. And by watching the nature of price delivery, watching how each cycle has an expansion phase, you can identify levels where you can look for setups. And we're going to talk about this, I think, on lesson 2 or 3 of this first part of the day trading course, right? But what you can see here is that the market trades down into discount, lowers buy, expands higher, trades back down into this, which is a breaking block as we run the short-term low here, coupled with a bullish order block and a fair value gap. Sees expansion, returns back down into that same old fair value gap, never loses the mean threshold of this bullish order block, and then we see a final expansion for initial consolidation. That's during New York session. So this is a classic London makes the low and New York continues the deliver phase or deliver cycle for buy side. And this also ties into what I call the London Express. And the London Express is a 4 to 8 hour time window where London trades in one direction. And the reason for this is because 80% of the time London has in a bullish order flow, London has a very high probability of making the high or low of the day, and New York sees a continuation of that phase. So now let's just look through. Alright, so we have a bullish order flow here, or let's actually go back and look for when we had bullishness in price. So we had bullishness all the way up to the side. Alright, so we're gonna do a quick study here. We're gonna look for data. Alright, and we're gonna start from here where the deliver cycle starts from. We're gonna use the replay tool to see where the low of the day forms at. Is it during London session or New York session? Now note that my time, I think I'm gonna just draw out each session for you. Now here, the low of the day forms during Asian sessions. This is London session here. Start of London session is here, and Asian session starts at this time. So in this one, Asia makes the low, London continues the low, and then New York continues the low from London. Here we had weakness. I know we closed higher than the opening price, but this was a signature type day whereby the market was not really bullish nor bearish. But again, I want you to see how what's it called? London had the high, and then New York had a reversal, and then we closed moderately unchanged. That's because there was no high prices nor lower prices here. Again, I'm looking for only bullishness, because our anticipation is bullish order flow, so we're looking for only buys in the bullish order flow. So when the market was bullish in a bullish order flow, when did the low form? This is the start of London session. This is the end of London session. You can see the low form during London, and New York continued to run higher. This is not a bullish day. It was a relatively unchanged day. Here, a bullish day here. Start of London session. Let's identify that. You can see London makes the actual low of the day again. So this is the third time. Alright, all the 3 times we saw bullishness. Okay, I think the first one, it was actually Asia, and then the remaining 2, it was actually London. This was another bullish day in price. And London makes the low of the day again. This was a relatively unchanged day, so we're not interested in this one. This was a retracement day. We're not really interested in that one. This is a bullish day. London starts here, and again, I want you to see the repetitiveness of this. Alright, when you're trading in sync with order flow, majority of the time, the London session will start or will make the low of the day and will continue or carry over into New York, which is what we call the London Express cycle. Alright, it is a window of 8 hours, which usually starts from London session into the end of New York session. Alright, so if I delineated each hour of this, okay, 9, 10, 11, 12, 1, and 2. We have 1, 2, 3, 4, 5, 6, 7, 8, and then 9. Now, here we are not interested with or in the London launch hour or the London launch time period. So once we start delivery cycle, usually during London session, right, that's going to be the first 1 or 2 hours of London session. There will be a manipulation phase, which is what we call the jitter swing. And I want you to pay very close attention to this. You can see here that's in the second hour of London session we have the manipulation actually come into price. Then the London Express is a 4 to 8 hour time window where we are anticipating a very strong displacement in direction of our high time frame order flow. Alright, so this is the end of London session here. This is the start of London session here. So we have a 3 hour window for London session. And then this is the start of New York session here. And the end of New York session here. We have a 4 hour time window for New York. We're not really interested in London launch because a lot of times London launch is the changeover session or the carryover session between London session and also New York session. Alright, so it tends to go into consolidation. It is not one of the active sessions we trade. Right, we trade London session, we trade New York session, and then we trade New York close. And there are ways in which to anticipate price delivery during New York close, and that it's dependent on the context of delivery for New York session and also the context of delivery for London session. But we're gonna go more into that London Express on later videos. I don't want us to deviate from this. But again, you can see how every time we are, or majority of the time when we are trading in sync with daily order flow, London tends to make the low of the day. Here, Asia actually makes the low of the day, and this is start of London session here. We'll make a short-term low, and then New York continues the price delivery. Here is unchanged, so we're not really interested in this. Here's bearish, we're not really interested in that. Here is bullish, London makes low. New York continues that run higher. Here London makes the low, even though Asia started the expansion cycle, but we have a short-term low during London, and New York continues that delivery cycle higher again. Here is also the same thing. This is the start of London session. This starts London session. You can see this is the low of the day, and we continue that run higher into New York session, where we then have a reversal. So most of the times, price will form the low of the day during London, which is around 80% of the time, and then we'll continue the delivery cycle going into New York, right? And that's how you get your London Express, which we're going to talk about on a later video in this course. Now, when we are looking for a daily order flow higher, we have a daily, or we've identified a willingness in price to want to be one-sided and see higher delivery or displacement higher. Then obviously we're bullish and we're looking for strength in the market. And what we're looking for is we're looking for a market maker buy model. That's what we're looking to identify first. If we can identify that, then we're looking for the proper time window to execute in direction of that market maker buy model. Now, sometimes you can have a market maker sell model that is not complete. Now, remember, in a bullish order flow, you're looking for a market maker buy model. Now, you can see here, bullish daily order flow is here, and we have a small little consolidation. You have your lower sell. You have your second state distributions, or small little consolidation, first state distribution, second state distribution. and then runs for a discount, which is this bullshit block down here. We're running out a short-term low there. Retail are sucked in looking for shorts because of the high energy displacement lower. That creates a pulling of buy liquidity up here. Market displaces higher. You have low risk buy back into a breaker block here. You have your displacement or deliver cycle higher, and then you have your reaccumulation here back into its old area of previous distribution, and then you have your run for initial consolidation. But now inside this smaller market maker cycle, there is an even larger market maker cycle. Low risk buy, smart money reversal, low risk buy, reaccumulation, run to higher time frame objective here. You have your consolidation, you have your lower sell, you have your redistribution here. And now here's the problem, because we're going to talk about the market maker sell model on the next video. In a bullish daily order flow, do not expect a complete market maker sell model. What do I mean by a complete market maker sell model? That means you don't expect the market to run out the initial consolidation like in a complete market maker buy model where we run out the initial consolidation. Right, so with the market maker buy model, we have the initial consolidation here, which is used to build in liquidity for hedging in price. We understand that daily order flow is bullish, so we know that price is going to seek the least path of resistance. And that's what we talked about on the last video for the short-term trading course, where we talked about how the least path of resistance is always going to be in the direction of daily order flow. Daily order flow is bullish, so the least path of resistance is always going to be in that direction of daily order flow, aka we're looking for short-term highs or premium rate. Right, so a complete market maker buy model would be seen a run through that initial consolidation. But sometimes, remember, the market can also engineer a sell model inside a daily order flow. Now, what you're going to notice here is that the sell model actually occurs as a TGIF. What is a TGIF? It's a reversal profile during a specific time of the week. That's what a TGIF is. Actually, I think I'm going to add that to the as a supplementary video for module 3. So we've done presentations on what TGIF is, and that's going to be added to the short-term trading module course, so you have a full understanding of what a TGIF is. Alright, so what you can see here is on Friday we have a reversal profile, which we've talked about, and the market does that reversal profile in form of a market maker sell model. You have your initial consolidation here, you have your displacement, you have your return back up into premium for your lower result, and then you have your displacement lower, and then you have your redistribution, and then you have your run lower. But because daily order flow is bullish, we don't expect the market to run out the initial consolidation or the initial low, which is down here, because we're looking for a bullish order flow. So a lot of times, or not a lot of time, majority of the time, when you have a market maker sell model inside a daily bullish order flow, it is going to be incomplete. And if you're wondering what's the market maker sell model look like, or what does a complete market maker sell model look like, we're going to talk about that on the next video. That's going to be the next topic, the market maker sell model, and you're going to see what a complete market maker sell model looks like. But in a daily bullish order flow, what we are looking for is bullishness or buys, longs. Why? Because we're trading in sync with daily order flow. Now, that does not mean you cannot go in and look for day trading sells against daily order flow, but it has to be in alignment with time of the week, time of day, and context of the liquidity draw, lower time frame liquidity draw. You can see here we have very clean news down here, which is where the market ultimately reached for on Friday, right? And then during the same changeover session into Monday, you have your valuation by speculation. Market aggressively runs for one random level. It's not a random level, it's a key time frame level, which induces retail to think we have or we're now bearish, because you're looking at this as breaking structure, right? We're making lower highs and lower lows and lower highs and lower lows. So right out the bat on Monday, the market just aggressively runs lower, and our retail is convinced they are looking for weakness in price. And I've taught you this: when you see the sudden run lower against order flow during the start of the week with no major economic release, that's the market running aggressive for a valuation point on a central bank level, where they will then start to offer liquidity. And you can see what ensues after. You have your smart money reversal, and you have your lower SPY inside this previous range, and you have your reaccumulation up here, okay? And you have another level of reaccumulation, and then the market finally runs for the original consolidation. So you can see how in a bullish order flow, we always have a complete market buy model, but an incomplete market sell model. So this is something really important to know. Like here, in this front lower, we have a smart money reversal, lower SPY, run for initial consolidation here. But on the retracement lower, we do it in the form of a market sell model. We have a smaller consolidation, we have a lower sell, we have a redistribution, and then we have the run down into support. But it never runs below that initial consolidation. You can tell it never runs below the initial consolidation. But when we have the buy model, it usually is complete. And that is a characteristic of bullish order flow. In a bullish order flow, you will see an incomplete market sell model, and you see a complete market buy model. When I talk about the market sell model, this would all start to come together, and it'll make a ton of sense. Alright, so I'm going to see you in the next video. Hopefully this was insightful, and trade safe.